December. Welcome everyone to the December Taxation Law Section webinar of the San Fernando Valley Bar Association. Glad everybody was able to join us. One point I wanted to add to Linda's comments, there is another webinar tomorrow, the last webinar of the year, and Jim Cunningham, an estate planning attorney from Northern California, will be speaking about running the practice management, and profitability. I have a slew of tax webinars scheduled for 2026, and you'll get notifications about those. We meet on the third Tuesday of the month, and you'll get notifications from Linda on those as soon as I can get the announcements ready to go and get them to her. Today, I invited a close friend of the San Fernando Valley Bar, preeminent tax lawyer. We can spend the whole hour talking about Sharyn's accomplishments, but just a couple of highlights. Currently, Sharyn is a professor at California Polytechnic University, Pomona, in their College of Business, teaching courses in the tax field. And for about 5 years, Sharyn was the director of the Office of Professional Responsibility at the IRS. She was appointed right around COVID in 2020 and retired in early 2025. And there she was instrumental in making sure that tax professionals are complying with their ethical obligations. And before that, Sharyn was a practitioner with Hockman Salkin, with that Reddick, Tasher Perez, and Beverly Hills. She's a prolific author, speaker, and has been, I think, in 3 or 4 states in just the last 2 months in speaking engagements. If you follow her on LinkedIn, you'll see her presentations. And she's going to be speaking about ethics and sustainability, ethical sustainability of your tax practice. Thank you, Sharyn. Really appreciate your presentation and looking forward to hearing your comments.
Thank you so much. Always so nice to be amongst locals. So excited about it. All right, let me share my slide deck here so we can all get our ethics credits like we want. All right. You should be able to see it.
Not yet. It's still the black screen.
Oh, all right. Thinking about it.
Nope. For some reason, mine's still showing black. I think you just have to...
it's saying the share is paused.
Hmm.
All right, I'm going to stop and go back in. How's that?
Sure.
Yes.
This is what I get for taking it down, right?
There you go.
Perfect. All right. So I'll leave my my camera up for a little bit, but if things get a little jittery, let me know and I will go off camera. All right. So my presentation is about building a sustainable practice through being ethical, both what we want, right? All right. So we're going to talk a little bit about professional standards, the foundations, because we all need our ethics credits, and that's more of the nitty gritty stuff. But I'll probably gloss over a lot of that. Only geeks like me and a couple other folks really find it interesting. But more of what we'll be addressing, which is more of the fun kind of real life events. And by the way, if anyone has any questions or comments, do feel free to just hop off mute and make them. I don't mind comments, interruptions, tangents in our conversation. So it makes it much more engaging. So we'll talk about the middle pieces about how we can build strong ethical foundations at the pre-engagement phase, when we're accepting those clients and onboarding them, then when we're actively managing their tax matters, and last, when we are done with them or they're done with us, whatever comes first. Just kind of a big concept is everybody knows to have a very good tax practice, the individual needs to have substantive tax knowledge. But I would say that there's another equally supporting pillar, so that there's two of them actually, and that is ethical conduct and adherence to professional standards. It doesn't matter how smart or knowledgeable you are on tax, if it's applied in an unethical or unprofessional manner or ignored completely, then you're just going to end up getting your clients in trouble, same as somebody who is unknowledgeable, who's incompetent. So our foundation, we have quite a number of it, and why we want to talk about building this practice through ethics. It's going to help us with our client relationships. It's going to help with our risk management, which is always close and personal to us. And then it'll also help overall with respect to your professional value, your reputation, your credibility. Like I said, I'm going to go through these a little quickly. So if we are ethical in our practice, we have good professional standards, we end up with having strong client relationships. Either that's through drawing clients to us because they know we are responsible, we're ethical, we'll handle their matter, but also warding off is a polite way to say it, those clients that we don't want to have. And we all know about the clients we don't want to have. The ones who are always trying to engage in fraud or tax evasion or unsubstantiated positions, and they are constantly harassing us or demanding or threatening, whatever it is, us to do things that we know would be in violation of our professional standards. And they're just a pain to deal with, right? It just gets unpleasant. So we get that strong client relationship. We end up having a stable practice. That means a stable practice gives us this professional success. Need to fix that slide a little bit, or profesionia, the Spanish version of, and then we have the whole industry in itself is stable, and that enhances the reputation overall of tax professionals. And as lawyers, we need as much representational enhancement as we can get. So we have a number of things that we have to abide by. I would have to say that probably tax practitioners are hyper regulated between what we have to adhere to under our state statutes, what we have to adhere to under our bar licensing, what we have to adhere to under our federal statutes, our federal oversight organizations, and then any organization we happen to be a member of, like the ABA or if we're dual credentialed, it's super layered. So we have a lot of regulatory and governing bodies that are going to tell us what to expect from us, our professional conduct, set forth those clear ethical guidelines, and then, of course, accountability measures when that is violated. So mainly what I will be talking about is, since all of that regulation, the one I will be focusing on, of course, is Circular 230, one that's near and dear to my heart. And to be honest, it's the one that's been around the longest. I mean, it was enacted in 1884, well before there was state bar rules, well before there were even before there was an IRS, to be honest. So this is the oldest. And you can see that it was quite a focus, even way back in 1884, that folks be ethical and be professionally fit to practice before the Treasury Department. So it does authorize the Treasury to regulate who can practice before it and how they practice. It determines whether that individual is fit to practice. It establishes all of the standards that we have to adhere to, including written advice, and it unfortunately does provide for disciplinary actions should somebody violate these standards and rules, and that would include monetary penalties. So we all know what fitness to practice means. We've heard it many times under Circular 230. And to be honest, it's the same of any profession, right? We can use these same criteria for our doctors, for our architects, for our engineers. We want somebody who has good character, demonstrating honesty, integrity, good reputation amongst their professionals, their standing amongst the professionals. They have the qualifications to do what we've retained them to do, and the competency to actually effectively serve their clients. And we also know there's a big difference between qualifications and competency. All of us are qualified. We've all passed the bar, we keep our license up, but our competency ranges. Since this group tends to be focused on tax, I don't know how many of us would take on a government contracting matter. We're definitely qualified to do it. We just may not be competent to be able to serve a client who has that kind of need. So we all stay within our lane and we all stay within our expertise. All right, so this is the circular. I hope it changes. It has not been revised since June of 2014. There are proposed regulations out there. We'll see if they get enacted. So it does contain all of the items we're looking for, our definitions, what is expected of us, and what happens to us if we don't adhere to them. And then OPR is the oversight organization that administers and enforces those regulations in Circular 230. The office does investigate when there has been allegations of misconduct by a practitioner. And if there is a determination there was misconduct, the office imposes disciplinary action. And by the way, just kind of a big picture, OPR does look at a tax practitioner holistically, meaning that when a referral is made to OPR, we don't focus on just that referral, but we look at everything about that tax practitioner. We look to see if there were prior referrals in our history. Our case database, we keep everything. It just stays. So we can see if there was referrals for this practitioner 20 years ago. Was it for the same issue? Which just means they haven't learned their lesson, or they've slipped in what should have been doing. Also shows that they had a very good track record, at least for 20 years. So this could be an isolated event. We also look at their tax compliance, not only for themselves individually, with respect to their filing and their payments, but also with respect to any return that they are responsible for filing, which would include let's say the entity return, if it's a firm or a partnership, any fiduciary returns they're responsible for if they're acting as a guardian or a conservator or as a trustee. We also look to see if they have had, so we also do payroll tax returns. So again, we look at absolutely everything. And then we also look at their state bar or board of accountancy to see if they had issues there. So big picture. All right, we all know this, right? Who falls under OPR's jurisdiction? Attorneys, CPAs, enrolled agents, some other retired, enrolled folks. Our AFSP program, it's annual filing season program, appraisers who submit appraisals. And if you've looked at the proposed amendments, we point out to fall in line with Loving, which is a case that said that OPR did not have, the IRS did not have jurisdiction over tax return preparers, or because, quote, mere tax return preparation is not representing before the IRS. We have modified the circular to clarify that, remove our references to our return preparer program. But we also clarify that if somebody is preparing a return as part of a representation, then they do come within OPR's jurisdiction. All right, we're gonna skip ahead for a few things. So let's get, here's a good start. So before we start, I wanted to throw in best practices here, because throughout this presentation, I'll have put little, gold certificates, gold stars, awards there when we have some best practices or things to think about that could be best practices to avoid some of these issues. So 10.33 is aspirational. It basically means that you cannot be sanctioned for violating 10.33. But what we do find in OPR is that usually if somebody has not adhered to best practices, they have violated other provisions within the circular, such as lack of due diligence or failure to meet the standards. So best practices are key and can be an indicator that someone has committed or has failed to adhere to their professional obligations. Hold on one moment, I just need to sneeze. All right, sorry about that. There we go. All right, so let's talk about best practices with respect to onboarding clients. And whether we want to onboard those clients. That's our bigger question. So first, how are we going to advertise for those clients? If you looked at the circular, as I mentioned, it hasn't been updated since 2014. So a lot of its focus is on kind of the older ways we do solicitation. It talks about if you put an ad in a paper, when we talk about fees, if you put an ad in the paper, you have to adhere to that fee for the next 30 days. I don't know about you guys, but how many of us are using newspaper ads anymore to solicit for clients? We're more using social media, the internet. Some use TikTok, some use LinkedIn, Instagram, any kind of those items. And they don't have those regular kind of publication cycles. So we did try to update the circular to address some of that. But when we are doing solicitation, regardless of the form that we're doing it in, there are ways that we have to adhere to Circular 230. So obviously in anything we put out, we cannot have any false, fraudulent, or deceptive statement or claim. And I'm sure you've probably encountered this in your practice where you've had somebody come in, a client or even a new client, and say, I saw this on TikTok, or I saw this on Instagram, or I got this email in, or I found it on Facebook about this tax transaction or tax position or tax product, and I want to do it. And then, of course, you have to tell them that 30 seconds on TikTok is not an appropriate amount of time to determine whether a complex tax transaction actually applies to their situation or whether even the transaction is real. Usually is vague or deceptive. So we're having to unravel all of these items just to give good tax advice. So we want to make sure we are not contributing to that bad tax advice. And anything you put out there that somebody could misconstrue and then say that, well, this person said I could do it, et cetera. Because if they get picked up by the IRS, first thing they're going to say is, my tax professional told me, or I saw this tax professional's ad, or something along those lines. All right, the other is there are rules about making uninvited solicitation regarding federal matters. So there is sorry, that's solicitation as well, but let me go back to this one. There's a difference between just regular advertising, which is just a general speaking to the general public, versus solicitation, which is when you have directly targeted someone. And it could be because you've gotten lists of tax liens from your county recorder's office. So you would, when you write to them, so you would have to identify that. And then this goes part about the fee schedule I was talking about. If you do put that in your advertisement, You don't have to, but if you do, then you need to put in basically what those fees are, whether it's hourly, fixed, range of fees, whether there's a fee for initial consultation. All of that is something you could put in there. You do need to indicate whether costs are to be charged to the clients, additional things. And here's that point I made about the, the published rates for at least 30 days after the publication. So if you've put something out on, say, I don't know, I don't do TikTok, so I'm not real good with it, but I do LinkedIn. And I know when I post something, that's when I've posted it, but people can repost what I have written, which arguably could mean that, if I had a fee schedule out there, it would up it for another 30 days because it's been reposted, even though it wasn't done by me. And so we could perpetuate a cycle where you're stuck with your fee schedule for quite a long time because people are reposting your information. All right, some best practices for solicitation. Avoid just specific tax advice or endorsing products or services unless you are going to disclose that you might be getting a referral for those products or services or commissions, and specific tax advice. We all know we generally cannot give specific tax advice unless we know the taxpayer's specific tax situation. We can give general tax advice, but without knowing a taxpayer situation, it's pretty tough to give specific ones. Other than, file your tax return, that's pretty specific. Make sure all your online activities adhere to ethical and legal standards by your professional organization as well as your regulatory authorities. So that's what I mentioned before. We have a lot of layers as tax professionals. So we have to make sure that what we're doing in our solicitation not only clears through Circular 230, but also clears through our state professions code and also is not in violation of our bar licensing. So we have to make sure we've hit all of those layers. And then if you have a firm or you're in charge of a firm, make sure you have clear social media policies and educate the employees on these policies regarding social media. And not to pick on the younger generation, but I'm going to pick on the younger generation. They tend to have a practice of oversharing on social media. And that can lead to a lot of issues. I have a pet peeve that as OPR director, if I was still OPR director, I would say something about it as in an alert. I have seen a number of tax professionals on LinkedIn post copies of their clients' letters from the IRS. Now, they do redact out their client's name, but they do leave other parts. They leave the little slashy lines that are across the top of that letter. Those are codes that can be read. Or they leave that, the little QR code item that's still in the letter. That also can be read. If they're not careful with their redactions, they could end up identifying a client that had a tax problem. And sometimes they put in there, saved my client $1 million, or I got a no change letter after a big audit. I can guarantee you that if we asked the client, they would say, no, I don't want my letter, my IRS letter, posted on LinkedIn for thousands of people to see. And I don't care if my information is redacted. I don't want it up there. It's my private information. And these folks, I think, will believe that they have, won a case, got a no change, reduced a liability by $1 million. But you're running such a risk posting your client's information on LinkedIn, which is, in perpetuity. People can copy that, they can repost it, they can share it. Identity thieves can use that copy of the letter to create false letters and steal from other taxpayers. And there's just nothing good comes from doing that. So, I see a hand up in the chat. Yeah, it's an absolute, and and I've written to a couple of people privately on LinkedIn about these letters, and because one still had an address on it, and I was able to zoom into the address. Now it ended up being the practitioner's address, but apparently who works from home because it was a home. Um, but we don't know that. And so it just looks like this person is unethical and incompetent because he just printed a letter, posted a letter with an address on it. It didn't clearly state it was his address. So yeah, just a bad habit to get into, that's for sure.
Sharyn,
Yeah.
one quick point on this on sharing information. Um, can you briefly discuss your thoughts on? I've seen a lot on LinkedIn as well, where not documents are being shared, but fact patterns are being shared without disclosing the identity of the taxpayer. What are your thoughts on that? And how is that a violation? Is that not a violation?
Say definitely a violation. Anything that can lead back to the client is going to be a violation. And embarrass, not even embarrass, anything that's going to lead to the client. So I've seen the fact patterns as well. No good. I have seen photos where folks are saying, did such a great job for my client, getting to sit in the client's skybox for the game. It's so easy to figure out who owns that skybox. And now we all know that that person had a tax issue. Um, or getting to dinner at the client's restaurant, anything like that. And that's why I think it's very important that we talk to our young associates who might not even be a perception that that's a problem. They're excited because they've got going to do something fun, right? Go to a game, go to a restaurant, get onto a boat, go visit something, and they want to share. So yeah, when I worked at the IRS, they were hyper vigilant on 6103, and they really focused in on any type of information that could be used to backtrack to the identity of the taxpayer. And you'd be surprised now with the post and listserv, absolutely. You'd be surprised with data analytics now how easy it is to backtrack to somebody. All right. Assessing competence. We all need to do it, right? So we can have a new client come in. I know we don't like to say no to clients or potential clients, but we're going to think about it as a mechanism by which we are going to protect ourselves. So if someone comes in or an existing client has an issue that we know we do not have the knowledge, skill, thoroughness enabled to handle, we should recommend that they go see a professional. If it is something that we can educate ourselves on and brush up, that is fine. If it's something that we can bring in an expert, that is fine as well. A consultant to help us, or somebody to that will handle the matter with us. But it's all about understanding our limitations. And a client, as we all know, thanks one, we're their tax professional for life, and that we know absolutely everything. And we don't. It'd be very impressive to find a tax attorney that knew everything in the code. So we just want to make sure we bear in mind what our limitations are and be honest with our client. And I do think that has a boomerang effect where we're not getting rid of a client. We're doing what's in the client's best interest to make sure that their tax matter, is handled appropriately. And a client is going to remember that, and they're going to know you were the one who maybe referred them out to get this additional help. and they will know that you are someone they can trust. They will come back to you, or they will refer people to you because they know you're ethical, you adhere to the professional standards, and you were looking out after your clients. So as I mentioned, under 10.35, we can develop that competency, research, educate ourselves, consult with someone else, or bring someone on board. But if none of those are going to work, then we will have to either decline that representation or withdraw. And of course, we would all hope to assist that individual by finding somebody who could handle their matter. Competency can arise on a number of ways, right? There's, I'm sure we are all taking classes on the One Big Beautiful Bill, or the OB3, as it is called inside the IRS, or we are reading about the OB3, we're breaking down the OB3, we're writing letters to our client regarding the OB3. So that's all that new tax implementation that comes in, a failure to update. I remember I handled an audit once, and and one of the issues had to do with a bad debt, where the accountant had taken the bad debt on the return, but also had a reserve put in place. But this individual was not in the financing business, and like you can't use the reserve for this type of business. And he goes, since when? I went, since about 20 years ago. It's been a long time. So we just want to make sure we've kept up to date on the new items. We are, of course, it could also be transactions outside our scope, but they can also, there will be technological competence. It is in the proposed amendments to Circular 230. There are statements that are made, I think, comments by the ABA. There is the AICPA, all putting in this expectation that we will all have a minimum basic technological competency. Does not mean we have to be IT techs, but it does mean that we have to understand how clients' information could be hacked or stolen, what safety protocols we could put into place to avoid that, how to exchange information to and from our clients in a safe manner so that we don't expose their information. We're going to protect, put up firewalls and virusware and all of that on our computers so that it is protected. And then we will have to look at, in our assessing our competency, any industry-specific issues. Let's say typically handle real estate clients, then we need to be up to date on the real estate, taxation of real estate transactions. So the best practice for this one, just regularly assess your skills, do professional development planning if there's areas that are becoming prevalent. Sign up for some continuing education, read some publications on it, et cetera. Instead of accidentally becoming competent, plan our competence so that we're ready for somebody walking in through the door. Know our good resource identifications, places where we can get good information, and have a good referral network. The San Fernando Valley Bar Association is just a perfect example of a great network system where you have everyone in, you meet regularly, you know each other's skills, who can handle what, and you know that they are competent, diligent professionals. So you feel safe referring clients over to someone for assistance. And that's just a wonderful thing to have in a practice. All right, let's talk about that initial client screening. We will check to see if we have a conflict, and we can have many types of conflicts, right? There can be a conflict between our current clients or former clients and this new client. There could be some sort of personal conflict between the practitioner and the client. And there could also be some sort of a material limitation on our representation for that new client. So we have to check all of those. The 10.29 is not an absolute bar. If there is a conflict, you can still go ahead and represent the conflicting parties as long as you reasonably believe You have the ability to provide diligent, competent representation to each affected client. There is no legal prohibition against representing them, and that could be under the State Bar Association, under the California Professions Code, in it, besides something else, besides federal tax. And then we do need written conflict waivers from all the affected parties, and those have to be received within 30 days of when you became aware of the conflict. And the key to these written waivers is informed consent. So if we cannot fully explain to each client what the conflict is and why, because maybe one client doesn't want us to disclose private client information to someone else, then we cannot get a conflict waiver, because one client does not have informed consent. And I remember when I was at the Hockman firm, we had a couple come in. They were clients. We did their estate plan, the usual. This is my husband. This is my only husband. We have 3 children. These are our only children, blah, 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 right? The basics that come in. And his was the same. This is my wife. This is my only wife. I've had no other wives. These are my 3 children. These are my only children. So we get all the information. We're going to prepare the documents, and we make an appointment with the clients when the documents come in. And the next day, one of the spouses comes back and tells us that they have another spouse currently in another country. They have 2 children with that spouse. They also have, wasn't another spouse, but it was a former, they had a relationship with someone, and they have another child from that relationship. And so that individual wanted to change their will to accommodate for the 2 wives and the 3 extra children. And then, of course, now we're stuck in a conflict. So we had to explain that we could not do their estate plan anymore. Fun times. All right. When we're bringing in clients, just to figure out whether we have a conflict, we also have to figure out exactly what that client is doing as a business. There's a lot of things now that can affect us legally when we take on someone as a client. You have someone who may be engaged in illegal activities. We have somebody who could be engaged in legal activities for state purposes, but are illegal activities for federal purposes. So if someone is in the marijuana business, whether it's recreational, medicinal, or growing, we need to know that. So we've got to have a very comprehensive client screening to find those red flags, right? Complex situations that may require expertise that we have, or things we need to brush up on, previous tax issues, including issues with prior tax preparers. We want to make sure our clients don't have unrealistic expectations, right? Like the guy down the street says, I'll do my return for $300 and I'll always get a refund. Not going to be happening in this firm. So we just want to, I like to think of using my engagement letter as I'm not real good with football, so I could be totally wrong here, as an offensive mechanism. I put things in there in my engagement letter that would avoid problems up front before the problem ever arises. We'll talk a little bit about engagement letters in a minute, but that initial client screening, think of it the same way. It's offensive. We are checking for things so that we don't have a problem down the road. Conflicts, unrealistic expectations, tax situations that we were initially not prepared for. So make sure you've got a really good consultation procedures. You've got standard forms that you can draw in that information. Check for your risks that may be with retaining or having this client retain you. Systematically check for conflicts. All of us do it when we're bringing a client on board, but we all know conflicts can arise during the representation. So it's always a best practice to do conflict checks regularly and be cognizant of conflicts, train your folks so that they keep that conflict in mind where they're dealing with items. We do have a conflict, we're going to promptly inform our client, have firm guidelines on how to get informed consent, how to talk about handling that confidentiality and the privileges, how long we're going to keep those conflict waivers, how they're written, where they're stashed, because if the IRS asks for them, we do have to provide them. And that is if anyone in the IRS asks for them. It could be OPR, it could be a revenue officer, revenue agent, appeals officer, counsel. It is not limited to OPR asking for conflict waivers. It's anyone in the IRS can ask for a copy of those waivers. All right, so now the client has passed our gauntlet. We are willing to let them have the privilege of us handling their tax matter. So let's get a lovely engagement letter in place. And we have a number of things. As I said, we want to use this offensively, but obviously it can be used defensively as well, which is a number of things we want to cover. Who's our client? I know that sounds silly. Like, oh, that's easy. Who's our client? But that goes back to our conflict waiver. When I was also at the firm, we had a client or company call up that was our client. The president of the company had used our services before. He had a close relationship with one of the attorneys in the office. He had used us for individual items, business items, you name it. And his company called up and said, we have received a levy notice from the IRS to levy the president's wages. And the president is telling us not to send the money. And we need to know what to do. Of course, the first thing I needed to know is, who's my client? Is my client the president of the company, in which case that's the person I owe a fiduciary duty to, or is my client the company who is calling me with this issue? So having a clear engagement letter, in this case, it was very clear we represented the company, so we advised what the company needed to do in their best interest. So think about if you're going to represent maybe a partnership and all of the partners. Could be fine now, but that has a propensity to have a conflict later if there's an issue between the partnership and one of the partners. Or one of the partners.
Sharyn, yeah. One quick, would it be appropriate to, if in that specific fact pattern, if the president or the CEO of the company was also involved in the conversations and the previous engagement, would it be appropriate to let them know to seek their own counsel?
Oh, absolutely. And then we would have to divest ourselves from those two issues, right? We have one client or one individual who has a direct conflict with our client. He wants our client to do something that they cannot do. So yeah. And we do that often, when we end up having a joint issue on an individual return, and we advise that one of the spouses could have an innocent spouse claim, that we look to see if they want to waive that conflict, if we think it's even waivable. And if it's not, then we will advise them that they would need separate counsel. We help them, we give referrals to who may be someone who could help them with their matter. If it's such a conflict between the two of them that we are now in a position where it could be a conflict for our firm, then we divest ourselves of both clients and send them to someone else, or send them to separate counsel. And again, that is something you can put in your engagement letter. If there is a potential for a conflict, whether it's a partnership and the partners or an LLC and its members, or between spouses, just mention there could be a conflict could arise in the future, and that, it will be discussed at the time. But if the conflict cannot be waived, then either client may have to go find a separate counsel, or I hate to say, you can put in your engagement letter which client you love most. You can say, well, I'm going to, the spouse is going to have to go find some other place because you want to retain a relationship with the other spouse. That's just something you could put up front. There's no surprises there, no hard feelings, because hard feelings is what gets somebody angry, what makes them believe, whether it's correctly or incorrectly, that there's been a wrong against them, and they make a referral or a complaint or file a claim against that practitioner. So again, I want to use my engagement letter to avoid all kinds of problems. We're going to define our services, what we do and what we don't do. That will also avoid misconceptions with clients, though that one doesn't work as well, as we probably all know, with our clients calling us about every tax matter under the sun when we've only been engaged to do this one thing. I left the firm, I left OPR, and I've already had 5 or 6 previous clients call me and ask for tax advice. Like, I don't even have an engagement with you. It's not like my engagement is still valid from 6 years ago. So we try. That's all I can say. But if there is
that's a challenge, because you develop a relationship. They know you, they like you, they trust you. So it's kind of reactive for the clients to call, even though it's unrelated, or it's several years down the line.
Yes. But and all I need to do is say, I'm happy to help, but I need an engagement letter, and we'll deal with it there. They're usually looking for immediate assistance. So it can be quite challenging. To me, the engagement letter with listing what you are not doing will be the most helpful. It's not going to really ward off your clients from asking you about stuff that's not within your engagement service. There's just, I feel there's no stopping that one. It's like a toddler. When you tell them no, they just keep going. But what it is going to do, it's going to protect you in an OPR referral. It's going to protect you in a malpractice claim. My engagement was very clear. I don't handle the collection side of it, or I was only handling this piece, the audit, or is only handling putting the position on the return or drafting a disclosure statement, so that you make sure that no vagueness accidentally pulls you into a malpractice matter or an OPR referral. Well, you can always put in the client responsibilities. Trying to get the clients to adhere to responsibilities is always tough, but at least it's in there. And also, having those in there can give you an easier grounds and basis if you want to terminate a client matter. And if they assert that you terminated in a manner in which it has detrimentally affected them, you can at least point to there was a basis for the termination. Your clients are going to provide you the information you ask for. They're going to provide it promptly. They're going to be responsive to your requests. They're going to be truthful. All of those items in there. I would also, as I mentioned, put in this offensively, put things in there that could be an issue, such as at least I see a lot of CPAs are using bookkeeping or preliminary tax preparation services that are outside the United States. Let your clients know that that's happening, that you are sending their information outside the United States. There's consent forms for it. Let them know you may use intermediate service providers to obtain transcripts, if any of us use some of those service providers to get tax transcripts. Let them know if you use AI services, whether they're in-house or subscription services, not the public domain services. But all kinds of things that prevents confusion, misperceptions, whatever it is. We're going to put that client on notice about it, so we don't have clients who somehow believe that their identity theft issue arose because you sent information offshore. So put in the fees, integral part. It's under 10.7 now, but do look at the proposed regulations. There that eradicated 10.27 and moved some of these items over to disreputable conduct, which is not a good place to be. So that had to do with unconscionable fee, charging unconscionable fees, which OPR tends to look at as a big fee for really bad advice, like poor advice. The old bait and switch, I'll do this for $300, but then when you're done, it's going to be $3,000, not because there was any complexity that caused the increase, but because the practitioner saw how much the client was getting as a refund. So any of those situations. The proposed regulations eliminate pretty much all contingency fees. And move the charging of a contingency fee over into disreputable conduct. Not many practitioners were happy with that move. We can discuss it. I have a whole slide deck on proposed amendments to the circular. So if we want to, at some point in the 2026 year, chat about that, I'm happy to give my thoughts. And then always communicate about the fees. All right. This is our unconscionable fee. I already talked about this. This is contingent. Currently, we cannot charge a contingency fee for filing an original return, but you can do it with respect to an examination or challenge the return, an amended return or a refund claim, for request for abatement of penalties or interest or any judicial proceeding. Under the Sexton case, you can charge a contingency fee for a refund claim or claim for credit, a refund claim for credits. The amendments prohibit that. Some best practices: put in clear scope definition, your service limitations, how you're going to communicate with clients. Maybe you communicate through emails and drop boxes or private platforms where they can load and upload documents, who you're going to disclose client information to, again, those third service providers or intermediate service providers, your AI subscription service, your offshore assistance, conflicts of interest, termination of services. We've got our fee structures, expense responsibilities, costs for handling additional services. There's some other things. I don't think I stuck it in here, but again, going back on the offense side, if you have had maybe issues in the past that you think could have been cleared up by putting it out in an engagement letter, do put that in there. One of the things I hear often is record retention. Got folks who have got records from 20, 30 years ago. They have to safe keep those records and they can't find the clients. So put in your engagement, this is not going to help from 20, 30 years ago, but put in your engagement letter that when the services are complete, the records will be returned to the client, or the client can have the option of disposing of those records in a safe manner, of the destruction of the records. And then, when that time comes, make sure you've got the receipts, the client signs, it's okay to either return those records or destroy them. So just get it all in there. A lot of us are using virtual paperless offices. So we have to safe keep all of that data, that we call it toxic data, because if you're hacked, you've got things from 10 years ago, for somebody who's no longer your client, then you have an exposure liability. So talk to your client about transferring that data to them, or being able to destroy the data. And I know as lawyers, wow, saying we're going to destroy something, that just makes us want to cry. But it's just burdensome for all of us to hang on to that stuff. And it's a risk for all of us. All right, information gathering under 10.22, we do have to make sure we've exercised due diligence and collecting information and meeting our clients so that we can prepare, approve, file anything relating to an IRS matter, and so that we can determine whether oral or written representations we make to the client or we make to Treasury are correct to the best of our belief. And of course, clients lie to us. And for us, it's just a matter of digging that out, which means, I think on the next slide, there's a safe harbor. We can generally rely on what our client tells us without verification, but it's not a carte blanche. We're okay. That's just what our client told me. So I don't need to do anything further. If there's information that we know or we should know, we have to take that into consideration. If the information our client gives us appears incorrect, incomplete, or inconsistent with other facts or assumptions, we're going to have to get that cleared up in order to say that we met our due diligence. And all of that, my advice to you would be put it in writing. Clients don't like stuff in writing. You know how it goes. You write them something with a list of questions, they call you with the answers. But the writing is going to protect you. The writing is also going to protect the client. Maybe the client misunderstood, or maybe the client didn't realize that additional information would help you. I had a classic example with a client who had an FBAR matter. And when they came to me, it was a Swiss bank account. And they said, look, I asked my CPA if I needed to report this account. And the CPA said, no, I did not. And so if you recall in the FBAR matters, we have to then go say, who advised the client. So I did call the CPA, and this is what the CPA told me. The client called and said, my mother passed away. I've inherited property, stocks, and cash in a bank account. Now, the mother was a U.S. citizen. The client was a U.S. citizen. No one had an accent. No one, as far as the CPA knew, lived outside the United States. There was absolutely no indication. Nothing appeared incorrect or incomplete or inconsistent with what the CPA knew and what the client was telling him. And there was just, the CPA said, I had no reason to ask if it was a foreign bank account, because everything was pointing to this was a domestic individual who passed away in the United States and their son inherited. And I told him an inheritance is not taxable. He didn't say money in a Swiss bank account doesn't have to be reported. So the client didn't know where the bank account was located was an important fact. And the CPA didn't have any facts that would make them think that he should ask where the bank account was located. So neither client nor CPA were lying, and neither were trying to hide anything. It was just a big miscommunication. So, and of course, this was in the early days of FBARs. We're all educated now. We all know to ask where is the bank account, or does anybody have a foreign bank account? But back then, that wasn't high on our radar. So it's just helpful to ask questions. And I know we don't like it when we challenge our client. Our client certainly doesn't like it when we challenge them. I always preface it with, look, I'm going to pretend to be the IRS here and ask some questions. And then I can go ahead and ask those hard questions and just say, well, this is what the IRS is going to do. Like I had one client who took massive casualty loss deduction, well, massive considering what it was. It was close to 100,000, slightly over 100,000, a casualty loss. They were under audit. I asked what the casualty loss was for. She explained that she lost a bunch of designer clothing, shoes, purses, belts, etc., due to sewage backing up into her home. And I was like, how did the sewage get so high it got to clothes hanging in a closet or clothes in a dresser or shoes in a shoe rack? And she's like, oh, I have a spare bedroom and I keep all my designer clothes folded up on the floor of this bedroom. Now, I don't know about you guys, but my designer clothes, which I don't own, would never be folded up on the floor. But all right, we'll go with that one. I said, all right. So did anything else in the apartment get destroyed? I mean, if the sewer backed up and it flowed into a bedroom, it didn't flow into, let's say, a living room and take out the rug or the couch or, dining room table, feet or chairs. Nope, it just went into this one bedroom and got all the clothes. Like, all right, I'm noticing your address. You live on the second story. So you mean to tell me that sewage backed up all the way through the first floor and made it to the second floor, traveled down a hallway, didn't go anywhere, but down into one bedroom and got all of these clothes? And, if you tell that to the IRS, no insurance claim, no claim against the landlord, no proof of damaged clothes, no receipts for any of the clothes, no photos of the damage, no city services. I mean, I'm sure I could have gone to the city of Beverly Hills and asked, was there any sewer backup at this residence or on this street? So clearly we could not tell the IRS that information. It seemed incorrect, incomplete, and inconsistent with other facts or assumptions. And we don't want our clients to commit fraud and go from a civil audit to a criminal case. So gather good information, have systematic collection and follow-up procedures, documentation requirements, and verification protocols. This is helpful for some of our newer employees. It will help them organize their thoughts, things they are supposed to collect. If we have this procedure already in place. And then again, most of us, or a lot of us, are going to paperless office, which means we might have collected all that information, but if we can't find it, it's not going to be real helpful to us. So have procedures, naming procedures in place so that you can find those electronic records. Nice organized systems. And again, if it's done electronically or even, I would say even physically, we're going to have security protocols in place to help us find these items. And record retention. I just glanced at my watch. Time flies when you're having fun. It's already been an hour. What should we do?
Silence. Do you want to make some of the most important highlights in the next few minutes?
Actually, I just flip through and point out some things you might want to read on your own. How does that sound?
Great.
All right. So, which was good because this is we turn to the active phase. We want to make sure we're hitting our standards just because we're legally required to, right? Not only under the code provision, but with respect to circular 230. Always, if you're hitting reasonable basis, make sure you do disclosure. It's required. It's reasonable basis plus disclosure. I'm a huge fan of disclosure. I used it often in my practice, even when I didn't get the reasonable basis standard. And I used disclosure in many cases where I wanted to avoid questions by the IRS. And I made sure my disclosures were really good. Here are the facts. Here's the law applying to the facts. This is why there's no question here. This is why we took this position. I think that's going to be really important on a go forward, more important than usual for the foreseeable future. With the IRS at a reduced capacity, it doesn't necessarily mean that there will be no enforcement. It might mean that there's going to be the same amount of enforcement, but very slow, protracted proceedings dealing with inexperienced revenue agents and tax examiners, revenue officers, and we really need to have our cases together, everything ready to show them, like a show of force, basically. We answer all of their questions easily to avoid an audit rather than having to defend in an audit. We know what these are, we know what our things are, due diligence, best practice, errors and omissions. Look at the new proposed regulations that caused a lot of consternation with the ABA and some others. I don't think it's as bad as it sounds, but happy to chat about it some other time. What we put in our written advice for our clients, just make sure you maintain that relationship. Keeps clients from being anxious or feeling like they're being neglected or worried that their matter's not being handled. Just that constant touch up, I don't know, once a month, just send them, if nothing's happening, send them a message once a month saying, been a month, I know I haven't, there's nothing happening on the IRS side, but I will keep you posted. Just gives them that constant attention so that they feel confident their matter is being handled. Do your WISP if you need it. It's Pub 5708. It does also have an example WISP in there, and there's an OPR alert about needing that WISP. It's a written information security plan for the data on your computer or the data that you hold. And then this is client records. We do have to safe keep them. You can't pass your records on to somebody who's buying your firm. Or if you pass away, your heirs or your fiduciary for your estate has to safeguard the records as well. No throwing them in the trash. So OPR did an alert on that one as well to help you with that one. And then my big advice: withdraw your authorization forms if you no longer represent the client. Don't with the IRS still thinking you are responsible for that client. So. And this is our continuous duty of confidentiality. So we have to keep protecting those records until we get rid of them. So, all right, that's it. And here's OPR's information.
Thank you very much, Sharyn, for all this information and also the 65-page PowerPoint. It's a great resource.